Okay, welcome to Senate Finance Committee, February 2nd, 2022. We have 5 bills today in front of the committee, starting with Chair Kelly's bill, which is Senate Bill 252. So I'll be the chair for that first hearing, and then I'll yield it back to Chair Kelly. So with that, Madam Chair, why don't we start with Senate Bill 252, your bill. And you're muted, Madam Chair. You're muted.
Okay, now I'm unmuted. Thanks so much. Colleagues, in 2017, the Maryland Financial Consumer Protection Commission issued its interim report and recommended that the Office of the Commissioner of Financial Regulation, the OCFR, be given enhanced authority to investigate and bring enforcement actions for unfair, deceptive, and/or abusive acts or practices in consumer transactions involving non-depository entities and persons. These restrictions were to be similar to the prohibitions contained in Title V, Subtitle 8 of the Financial Institution article that currently applies to banking institutions. I am pleased to sponsor this legislation to do just that. This bill will help the OCFR better carry out its mission of protecting Marylanders through the operation of a modern financial regulatory system that promotes respect for consumers, fair competition, and responsible business innovation. Senate Bill 252 promotes these goals by adding a provision to Maryland law that prohibits regulated entities from advertising, making representations, or engaging in acts that are false, misleading, unfair, deceptive, or injurious to public interest. Prohibitions, all of which state banks are already subject to under current law. Extending these provisions to all regulated entities increases consumer protections. It levels the competitive environment and promotes responsible business innovation and fair competition. Senate Bill 252 also prohibits other anti-competitive practices. For example, it prohibits lenders from imposing as a condition for a loan any restriction on obtaining credit, property, or service from a competitor, unless that restriction is reasonably necessary to secure the loan. Senate Bill 252 also includes some technical changes to harmonize existing confidentiality and enforcement provisions of Maryland law, all of which help the Office of the Commissioner continue integrating with networked supervisory exam systems, such as the Nationwide Multi-State Licensing System, MLSS, and the State Examination System, the SES, and ultimately harmonize their enforcement authority across regulated industries. Overall, Senate Bill 252 focuses on protecting consumers by extending existing limits against unfair, deceptive, and anti-competitive actions to all regulated entities, and simultaneously enhancing the OCFR's ability to effectively participate in multi-state, networked supervisory activities. With that, I request a favorable committee report. Thank you.
With that, thank you, Madam Chair. We've got one favorable, one unfavorable. Favorable, we've got Commissioner Tony Salazar from the Office of the Commissioner of Financial Regulation. Mr. Commissioner of Financial Regulation, Mr. Salazar, it's all yours.
Thank you, Vice Chair Feldman and distinguished committee members. For the record, I am Tony Salazar, Commissioner of Financial Regulation. I want to thank Senator Kelly for her sponsorship of Senate Bill 252, which I'm here to testify in support of, and also request a favorable committee report on. As Senator Kelly just mentioned, the mission of the Office of the Commissioner is to protect Marylanders through the operation of a modern financial regulatory system. And that means we need to keep up with the times and also have the ability to coordinate with other agencies throughout the United States. So in order to accomplish those goals, my office needs to take advantage of those supervisory tools that we have, and they're continuing to be modernized, and we need to make sure the law keeps up with that. Senator Kelly's bill provides that ability, and it provides the tools as well that were spoken of in the Consumer Financial Protection Commission when it realized that our office did not have certain authority that we had over depository institutions. So in order to bring similarity to both areas, since we are a regulatory agency that also charters institutions, we thought it best to include the bill, which prohibits entities, non-depository entities, from engaging in acts that are false, misleading, unfair, deceptive, or injurious. Those provisions are already contained in law, but they do fill out our office's toolkit so that we can take action against entities that we charter and regulate. I believe the extension of law is warranted to give my office the ability to keep up with marketplace activity and address the broad range of activities that have been undertaken by the non-depository entities. The bill won't negatively impact businesses. What will come to pass is that any regulated entities in the non-depository space that have been engaging in unfair, anti-competitive, or otherwise violative standards will be subject to our authority. So in sum, the bill implements the recommendations of the Consumer Financial Protection Commission to enhance our enforcement authority, and it supports my office's ability to effectively participate in current and future multi-state network supervisory systems and activities. So with that, Mr. Chairman, I request a favorable committee report, and I'm happy to answer any questions or provide additional information as the committee may request.
Thank you. Thank you for your testimony. Any questions for Commissioner Salazar? Senator Kramer.
Thank you, Mr. Chair. Commissioner, can you maybe give us a couple of examples of what it is that has occurred that is the catalyst to this? Has there been something that was brought to your attention and then you realized we don't have the capacity to be involved, or is this preemptive?
This is primarily preemptive. We have been taking steps since the Consumer Financial Commission came out with a number of recommendations. They had two reports. They had the interim and the regular. So we have been picking the areas that we thought we could get through. Don't forget, this also does two things. It does, number one, the unfair and deceptive piece, which is important for the enforcement tool. But our office works very closely with other states through the NMLS and also through other tools. What's being developed is this supervisory examination system, which allows Maryland and all the other 50 states to gather, share information and examine non-depository institutions. So the bill also includes that information. And since we do take enforcement actions on a multi-state basis, having this type of authority when other states all get together and pursue, a nationwide actor will have authority under our law to do that as well.
And can you give us some examples of the non-depository entities that will fall under?
Sure. The largest group, I guess, would be mortgage companies, mortgage lenders, money transmitters, check cashers, debt collectors, all the entities regulated by our office.
Got it. Okay. Thank you, Mr. Chair.
Okay, any additional questions for the commissioner? Okay, seeing none, we have one additional witness signed up unfavorable, Philip Robinson. Mr. Robinson, you're on the clock at 2 minutes.
Good afternoon, Mr. Vice Chair and members of the committee. My name is Philip Robinson. I am an attorney at the Consumer Law Center in Silver Spring, Maryland. I provided written testimony. I really have very specific objection to the bill that I think has an unintended potential consequence of creating a loophole. And that is, the bill and I don't have any problem with what the commissioner is saying in terms of the overall theme of enforcement of our consumer protection statutes in the commissioner's office. However, the bill gives the commissioner the authority to define terms that are already defined in the law. Specifically, it's giving the commissioner the authority to define unfair, deceptive, or abusive. And those are terms of art under the Maryland Consumer Protection Act that the legislature has already defined. So as a matter of statutory construction, I don't think it's wise to set up a system that might establish different definitions than already exist in the law. And I think quite honestly, it should just define those terms as they're defined under the Consumer Protection Act. And as you'll see with the next bill, that will level the playing field and make it easier for everyone to understand instead of having to understand different definitions and different provisions of the law. The Consumer Protection Act governs all of the activities to the entities in response to Senator Kramer's question. So there's really no reason why you couldn't incorporate those definitions here in this legislation if you're going to go forward. And unless there's any other questions, that's my main concern, is I don't want an unintended loophole created with different definitions created by regulation that already exist in the law.
Okay. Thank you, Mr. Robinson. We do have a question from Senator Kramer and then a question from Chair Kelly. Senator Kramer, we'll start with you.
Thank you, Mr. Chair. And I was going to say, it is not unique for us to have, depending on where it is in the code, similar, different definitions for similar words that are utilized in the statute. But having said that, I guess my question goes to the commissioner. Commissioner, would you be comfortable utilizing the same definitions for these terms, or is there a reason you would want to be able to create different definitions?
We would not be creating different definitions. As a matter of fact, the statute in the banking financial institutions article already contains that language. And I would have no intention, and prior to my tenure, no commissioner has utilized that action to go against financial institutions or change. So I think the understanding is, as Mr. Robinson said, that the unfair and deceptive comes out of that other chapter. We just wanted to parallel the authority. So to the extent you change this, you'd want to change the other as well. But I don't see that as happening.
Got it. Okay. Thank you for sharing that. Thank you, Mr. Chair.
Hey, Chair Kelly.
I just wanted to address the same issue, and I think the commissioner has done it really well. I sit on a bank board, which I helped to found about 40 years ago, and I was about to say, we've got those same definitions in the banking statutes already. And as other kinds of actors come on stage, sometimes we do need to expand in order to capture what is clearly unlawful and unfair to the public and to the clientele that is trying to be served, so that we keep up with new ways of stealing and new ways of being deceptive and new ways of impacting the public negatively. Thank you.
Okay, any additional questions for Mr. Robinson? Okay, seeing none, that will conclude the bill hearing on Senate Bill 252. Madam Chair, I'm going to yield it back to you, and then I'll split because I have to present a bill in another committee over in EHE. So
thanks so much, Mr.
yes,
Vice
back to you.
Chair.
Okay.
All right, we're going next to Senate Bill 217. Commissioner of Financial Regulation, Consumer Loans, Fees. And Mr. Commissioner, you're on.
Thank you, Chair Kelly. Good afternoon, Vice Chair Feldman and distinguished committee members. For the record, I'm Tony Salazar, Commissioner of Financial Regulation. I want to thank which one am I looking at here? Oh, I want to thank the chair for introducing SB 217, which I'm here to present and to request a favorable committee report on with amendments, which I understand that the committee members have. As you heard, my office strives to protect Marylanders through the operation of a modern financial regulatory system that, among other things, promotes both respect for consumers and responsible business activity. So we're proposing SB 217 to clarify the law and enhance consumer protection in the area of loan repayments. SB 217 helps reach those goals because it's based on three principles. Number one, loan payments made in cash or by personal cashier's certified check or by an ACH debit from a consumer's account, meaning the most common forms of payment must be accepted by lenders free of charge. Number two, any other payment-related fees must be disclosed and may not be upcharged, so they can only be passed through. Number three, consumer lenders are prohibited from steering borrowers to costly payment methods. These principles and the consumer rights that I mentioned are not found in Maryland law currently, and they're not provided to consumers by the recent case of Alexander versus Carrington Mortgage Services that was cited by the Consumer Protection Division in their written submission. The law on loan repayments has been confusing for both consumers and lenders, and that state of confusion is what was the genesis of this bill. It needs to be addressed. The Carrington Mortgage Services decision was issued a couple of weeks ago. The decision held that lenders may not charge consumers convenience fees for making loan payments unless the fee is first set out in the loan documents or it's authorized by law. And that proposition would seem to be true even if the lender only passes through the actual cost of accepting the payment with no upcharge. The decision does not prevent the charging of convenience fees. After Carrington, lenders can still charge convenience fees. What they need to do is simply add that and change the wording to their loan documents. By contrast, the passage of SB 217 would mandate certain free forms of payment, the most common forms of payment, and make the fees that were charged in Carrington permanently illegal. Additionally, because of the Carrington decision, without this legislation, Maryland consumers may lose access to convenient forms of payment, meaning that if they can't or don't pay on time and their loan documents don't authorize the charging of convenience fees, they'll simply incur a late fee. And that's a fee that could be avoided by the passage of SB 217. So SB 217 has clear rules on fees, and it contains consumer rights and safeguards not currently found under Maryland law or provided for in the Carrington case. It also makes room, because of its structure, for responsible innovation as new payment forms come into the market. Overall, the OCFR believes that these provisions are needed to protect consumers and prevent marketplace disruption and address the confusion that has been generated in this area of loan payments. So we've got some amendments in the bill, as you noted. They came up because the Carrington decision was issued after this bill was drafted. You probably know the bills are drafted, in the summer and in the fall. So Carrington was not yet decided. They came out of discussions with stakeholders and with the Office of the Attorney General, and they'll clarify the bill's prospective application, including ACH transactions as required free transactions, and they'll change the effective date to January 1, 2023 to give industry time to implement the documentation and any changes they need to make. My testimony above reflects those amendments. So with that, I request a favorable committee report on Senate Bill 217 with the amendments, and I am happy to answer any questions or provide any information as the committee may request. Thank you, Madam Chair.
Thank you. Are there any questions? Senator Kramer.
Yes, I'm inquisitive today, Madam Chair. Commissioner, I see my good friend D. Robert Enton is in the waiting room. I don't know whether he is here to support or oppose the bill. I suspect I have an idea. But I guess my question is, if somewhere there is language baked into, the pages of documents that, somebody's going to be paying a fee, and do you accept that fee? Is it going to really change outcomes to have this legislation in place? It's just, I can see that the consumer is going to be, signing all these documents, and often those documents are found online now. they don't even see the documents, and they have to find, elsewhere. But, baked in and buried and have no clue that A, they're paying it, or B, they're just going to assume, hey, I have no choice. So I guess the question is, would a flat out prohibition on the fees be a consideration, or is that not viable?
Senator, I think you'll find that there is opposition and support to the bill, and we had to, we did some negotiating with folks on that bill. So
Okay.
it's probably a good bill because nobody's really happy with it. When this bill was first drafted, there was no statutory law on this. Carrington was a case in process on the bill, and lenders could charge if you were 5 days away from making your loan payment and you had to make your loan payment. You call your lender and you say, hey, I need to make a loan payment. How can I do that to avoid, let's say, a $35 late charge or whatever the late charge is? They say, we'll charge you $5, plug in, use one of the methods of payment, Venmo, whatever, and that'll save you money on the other end. And so there was no law on that, really. If you wanted to find it, you had to go through the statutes, and we had discussed this with the Attorney General's office, and we couldn't come up with a way to address it. So there was a lot of confusion, as evidenced by the fact that the Carrington case came out. And so we decided, well, we ought to come up with the rules that we believe the case law had, which was there ought to be something in the loan documents up front. So that, because consumers do shop around, they do look for fees. And don't forget, these are convenience fees that would be applied, not the late fee, but if you're not going to make your fee, if you're not going to be able to do it in time. So they're going to have some kind of issue up front. But what we decided to do, and we spoke with the Attorney General's office afterwards, was to add ACH. So the most common forms of payment all have to be free. That's a new right for consumers. And then if, let's say, they don't have anything in the loan documents, right now Carrington says you can't charge a fee. So what happens? They don't provide convenience fees and the consumer gets stuck with a late fee, much higher. This bill says if you want to provide them with some kind of convenience, you have to disclose and you have to do pass-through.
Okay.
And that's pretty much where we are on that.
Got it. Thank you.
Are there other questions? Okay. If not, then we'll go to the list. Robert Enton, representing the Maryland Bankers Association.
Well, much to Senator Kramer's surprise, we are favorable with amendments on this bill. We spent a lot of time working and talking to the commissioner about this. We spent a lot of time talking with our members about it, and none of our members have a problem with the bill. I think that the good thing about the bill is the bill makes it very clear that you must offer now, I guess, 4 forms of payment, multiple forms of payment that have no fee attached to them. And the ACH, was an issue. We had to go back to our members. That was not in the original set of amendments we got from the commissioner, and the commissioner said that was something that the AG wanted. We talked to our members about it, and they're okay with it to the extent that we had any members that were charging that fee. For that, they said they will no longer charge the fee going forward, and they were all right with that. So we really do feel it's a good bill. It's a good compromise bill. It clarifies things, and we hope the committee will pass it with these amendments. We think it's good for the consumers, and it's not detrimental to the banking industry. Thank you.
Thank you. Are there other questions? Okay, thank you very much. We're going next to Chris DePietro.
Madam Chair, members of the committee, my name is Chris DePietro. I'm here on behalf of the Mid-Atlantic Financial Services Association. The MFSA is a trade association for non-bank lending institutions. So first, I just want to thank the commissioner for working with industry, because there were some questions when the bill first came in. But I think with the amendment, it strikes the right balance. And I think the goal here is to ensure that there are an adequate number of methods for consumers to make payments on their loans free of charge. And that's what we do. It's in our best interest to reduce the barriers for consumers to make these payments. We don't want to put barriers in their way that would make it hard for them to make the payment and make the payment on time and not incur a late charge or some other fee from another institution where they're perhaps are banking with. So I think the amendments, we had a lot of back and forth with the commissioner's office, very good dialogue. And I think that's where the commissioner is and wanted to strike that balance. And we are there with him on that. So with the amendments, we support the bill. Thank you.
Thank you. Are there any questions? All right, we'll go next to Philip Robinson, Consumer Law Center.
Good afternoon again, Madam Chair, members of the committee. My name is Philip Robinson. I'm an attorney. I represent your constituents statewide. I'm here in opposition to this bill, and I want to just sort of give you some context. There's no consumer advocate supporting it with an amendment at all or favorable. So that's sort of enlightening. I actually have a constituent who filed a complaint with the Office of the Commissioner on Financial Regulation 18 months ago because the commissioner's licensee was seeking a court order in Florida to modify every mortgage loan in the United States that it serviced, including thousands in Maryland, to permit it to charge $20 or more fees for accepting payments over the phone or by the internet, which literally cost the servicer pennies. To this date, 18 months later, the commissioner's office has not responded to that consumer's complaint. And so the cost of these collecting a payment is literally pennies. And I think to Senator Kramer's question earlier, the better legislation is to ban convenience fees. The cost of collections already baked into the interest that's charged on a transaction. And so I just don't understand why there's a need, because no consumer advocates agree that there's a need to authorize in the law a fee that this committee and the legislature passed 3 years ago, a law amending the Maryland Consumer Debt Collection Statute that did not authorize these fees. Just with all due respect to the commissioner's statement, this committee, as it's outlined in my written testimony, passed amendments to the Maryland Consumer Debt Collection Act just 3 years ago that incorporated federal law, and that law did not authorize these fees. So it's been clear for 3 years. And so this is really just seems like an effort to create a fee channel or to permit the commissioner's licensees to charge fees that otherwise they're not permitted to charge right now. And there really is no just basis for it, since all consumers pay interest on their transactions, and the interest includes the cost of collection, which in this case is pennies. And there's really no reason to add those fees or any fees for cost of collection to your constituents' accounts. And the last point I would make is there is lots of litigation on these issues pending around the country, and typically the General Assembly takes a handoff approach to bills like this one that seem intended to authorize the fees and undercut the pending litigation. So with that, I'd ask the committee to vote unfavorable on this bill.
I'm going to do something I don't normally do. I'd like the commissioner to answer, if you've got an answer, as to your take on the problem that this witness is addressing.
Sure. Thank you, Chair Kelly. Well, first of all, the Carrington case just came out recently, and up until the Fourth Circuit made its decision, arguably the fees were permissible. So the fact is there is confusion, or there was uncertainty under the law when we came out with the bill. The Carrington case does not prevent the imposition of convenience fees. The Carrington case says convenience fees must be authorized by law or found in the loan documents. So if they are put in the loan documents, they may be charged. I understand that the consumers have not, come out to support that, because I think it's a misunderstanding of how the bill actually works, because it provides for free methods of payment and it provides for the charging of pass-through fees, not upcharges. And so we believe that, if there's new methods of payment that come down the pike, they have to be disclosed. We believe that if consumers, and this won't affect existing loans, it'll affect going forward. So I'm not sure if it'll affect litigation. But if consumers are not given the opportunity to make payments at the last minute, I don't think it's reasonable to believe that the industry will eat the cost. I think there's also an equal risk that the industry will say, well, just pay in 5 days and you can pay the late fee. That's what that's for.
Okay, thank you. All right, let's go to James Kaufman.
Thank you, Madam Chair. My name is James Kaufman. I'm an attorney in Washington, D.C. Along with Mr. Robinson, we represented the borrowers in the Carrington case. I also represent consumers nationwide in dozens or more class actions involving these exact same convenience fees as violative of the Federal Fair Debt Collection Act and various state debt collection laws. Currently, under the Carrington decision, convenience fees are not legal in Maryland, period. There's an argument, well, it could be in the agreement. The agreements go back to the 1970s. They're standard agreements for securitization reasons, so that they can make securities out of the mortgages. Those agreements do not authorize convenience fees. And what that is that's a fee that would permit someone to charge up to $20 is what we've seen, just for submitting it online, over the phone, or for some other method. Now, as far as shopping around, borrowers in the mortgage space do not shop around. Their mortgages are assigned to a mortgage servicer. They do not decide my loans with this company. I don't like the fees this company's charging. I'm going to switch to this other company. They can't do that. The investor assigns the loan to the servicer, and there is no choice on the consumer's behalf. I do not see how this bill, in creating kind of a loophole to allow a servicer to pass along its costs of doing business to a consumer, can be considered anything but anti-consumer. The reason that I got involved in this case was originally back in 2012. I had a borrower that came to me who had a loan switched from Bank of America to another servicer and began to be charged about $15 every time she paid online. Through that process, we found that there was a contract with Western Union that provided for a fee of about 30 cents related to the transaction. Now, I understand what Mr. Salazar, Commissioner Salazar, is saying. Well, this just allows them to just get that 30 cents back. But, well, let's consider a different contract. Let's say we can contract with Western Union to do all of our IT, to do our call centers, to also help defray the costs of our employees, and we're going to pay them $3 a transaction. But then, because we've agreed to that, we're now going to pass that along to the borrower. Where does it go from there? Could we also say that because of my call center employees cost an annual amount of $1 million, I'm going to divide that up by the transactions, and I'm going to pass that along to the borrowers as well? And then we get into a litigation over what actually are the costs. We have to look at that contract and say, well, what's really the cost of doing business? And frankly, here, there's studies, and the Carrington case discusses it, the justices that consider that case, that opening a check costs roughly over $1. And that's the way that they have to accept mortgage payments right now. They have to accept a check. Everyone agrees to that. The cost of having someone open a check, process it, is about $1.50. The cost of taking it by the phone or online or ACH or otherwise is pennies related to that. It's no more than 30 cents per transaction. The other thing is that consumers typically aren't using checks nowadays. That's becoming less and less prevalent. People are now paying online. They're now paying by phone. Because they know this, these loan servicers are now saying, well, I'm going to pass along the costs of my call center regarding taking phone fees, regarding any other fee. I'm going to pass along to the consumer. And that just creates a huge issue here, frankly. It's a question of where does the fee stop, really? And the Maryland legislature has made it clear in the Debt Collection Act, and the Fourth Circuit has now made the decision that if it's not in the agreement, That's the loan agreement that are standard in all mortgages. It's not in the agreement. Or if there's not some law, unless Mr. Commissioner Salazar gets this written into law, which there is no law in Maryland that authorizes fees right now, you can't charge these fees in Maryland.
Okay,
That's a victory for the consumers. And I would ask the committee to continue to support Maryland consumers.
let me say this. I do see that the Attorney General's office, the Consumer Protection Division, has sent in unfavorable written testimony. We're going to hold the bill and not have a voting session until we have an opportunity to work with that office as well as with the commissioner to make sure what is going on. And if there need to be some amendments to the legislation, we'll bring it back to the committee for our joint consideration. Thank you very much. And that ends the oral testimony for this bill. Thanks so very much.
Thank you, Madam Chair.
Okay. We're going next to Senator Bottle, Senate Bill 293. And we'll remind people that as witnesses that you'll have 2 minutes each, and that we've got a lot of people waiting behind you to testify. So we'll give you a friendly reminder if that becomes necessary. Thanks so much.
Thank you, Madam Chair Kelly and Vice Chair Feldman and members of the Finance Committee. You've actually heard a similar bill to Senate Bill 293 when you heard the administration bill from the MIA. So this bill is just a little different. I'm bringing in at the request of the Maryland Land Title people. I have 2 proponents with me on the panel, Theodore Rogers and William O'Connell. So the bill is very similar, except they ask for 2 things: to change the word annual examination to annual review. And they have a problem with having MIA create the form that, when they have an issue to report. So 2 simple things. Whether we amend the original bill from MIA or choose this bill is really up to the committee. But I would like a favorable report for Senate Bill 293. Thank you, Madam Chair.
Thank you. Are there any questions? Don't see any hands raised. Okay, we're going then to Theodore Rogers, the Maryland Land Title Association.
Good afternoon, Madam Chair. I am Ted Rogers, president of the Security Title Guarantee Corporation of Baltimore. I'm speaking to you today on behalf of the members of the Maryland Land Title Association in support of SB 293. Currently, insurance statutes require title insurers to conduct an annual review of their producers on site. During the pandemic, the administration issued an emergency order allowing the reviews to be conducted remotely. Because those reviews were performed without any diminution in quality, the administration supported our proposed amendment to Article 10-121, removing the on-site requirement, introduced today as SB 293. This bill will reduce costs while continuing to provide the same high degree of oversight. The administration has introduced its own bill, SB 170, that also removes the on-site requirement, but adds a provision authorizing the commissioner to create a standard report form to be filed after every review. We do not support SB 170. In 2014, the MIA issued regulations requiring title insurers to send a copy of every review that they conducted to the administration. SB 170 would expand on that to codify their authority to create a standard report form to reduce the time they spend going through the many reports they receive. The problem, however, is not the form, but the requirement to file reviews when no violations are found. I looked at every review we conducted last year. 67% had no violations, while the other 33% found only minor violations. Assuming this is true for other title insurers, the MIA may be receiving thousands of reports each year with no violations found. In discussions with the administration, we have agreed in lieu of SB 170 to amend SB 293, codifying their authority to create a standard form for reporting violations of the insurance statutes by appending, quote, and in a form and format created by the commissioner, unquote, to the language already added to subsection K3 by the bill. For these reasons, we ask for a favorable vote on SB 293 as amended and an unfavorable vote on SB 170. Thank you.
Thank you. All right, we're going next to William O'Connell, the Title Insurance Coalition.
Good afternoon. My name is Bill O'Connell. I am an underwriter for First American Title Insurance Company, who is a member of the Title Insurers Coalition. I applaud the commissioner for her responsiveness to the title insurance industry in a time of crisis and her willingness to adjust the producer review process in light of what we learned from it. We prefer the industry's approach to the proposed statutory change as reflected in SB 293 instead of the commissioner's proposed 170 for the following reasons. The current bill still, the current regulations still require on-site review. While the commissioner's approach in SB 170 seems efficient by simply removing the words on-site from the statute, we assume the commissioner will seek to amend the regulations in response to the statutory change. We believe that a future commissioner could reinstate the on-site requirement by regulation. For example, current law requires title insurers to prepare a report of each review, and that report is subject to examination by the commissioner. But current law only requires insurers to report conduct that is prohibited by Insurance Code Article 10-126, which contains a list of bad acts. Current regulations, however, require that a report be filed with the commissioner within 45 days after each review, even if the title producer is doing everything right. Thus, SB 293 spells out all the different ways that the review may be completed so that there is no misunderstanding in the future. As for the commissioner's request to include a required form of the report, I offer the following. The administration, as Ted said, probably gets thousands of these reports every year, given that a report is required after every review, and that most producers write on more than one underwriter. That means they're getting reviewed at least twice, and that means 2 reports for every title producer. Some of them write on more than 2. We can see a need for uniformity to assist the administration in doing their work. But wouldn't it be far better to require a report only when there is something to report? Thus, we have no objection to the commissioner's request to create a form to be used for the report. All we ask is that it be required to be filed only when there are violations to report. Title insurers take these reviews very seriously, probably more so than the commissioner. Our request to report violations only is not about trying to avoid accountability or the review process. Instead, it is simply an attempt to focus on what really matters and avoid the time and expense of busy work for the administration and the industry. Therefore, we ask for a favorable report on SB 293. Thank you very much.
Okay, thank you. Are there any questions? All right, hearing none, then that ends the hearing on SB 293. What you say? Okay, we're going next to Senate Bill 278, Senator McCray. Go ahead.
Yes, ma'am. Thank you, Madam Chair, Mr. Vice Chair, and members of the committee. I come to you on behalf of Senate Bill 278. Just to let you know, I'm humbled. I'm honored to be the chair of what we call the Public Safety, Transportation, and Environment Subcommittee over on B&T, Budget and Tax. And for the past 2 years, colleagues, DLS has came with the recommendation that we put forward legislation to remove the barriers, the arbitrary barriers, by reducing the down payment and also increasing the amount of installment payments that are optional for the folks that are consumers of MAIF, what we call MAIF. Colleagues, I say to you that this legislation isn't earth-shattering, but let me be very clear, I do believe that we're on the right side of history. So I still find it very unconscionable that in 2022, that we have provided a segment of people a profitable business via statute at the cost of another segment of people who are poor with limited options. We have done this for decades, and it is time to remove those arbitrary barriers. It is time that we remove those arbitrary barriers because those barriers have been placed in statute, and there's no better time, Madam Chair, than right now. I come to you today with firsthand experience as a past MAIF policyholder. In 1998, Corey McRae, as a young driver, I purchased a 1987 Buick Century for $850, Madam Chair. And my insurance on the vehicle was $300 a month for liability insurance. And because I wasn't able to finance the payment, through Maryland state statute, I was forced to use a premium insurance company in order to do just that. Eventually, after 3 months, Madam Chair, I paid more in insurance than I had paid for the vehicle that I was driving. It's important for us to remember that as we utilize our vehicles, we utilize them for a variation of different reasons. We use it for employment, we use it for childcare, we use it for fresh food, prescription drugs, schooling, and many more things. But so many of these arbitrary barriers are in our way and having an adverse effect on a certain segment of people that are in my community. Now, Madam Chair, I want to get to the meat of it. For people and for Black people, the added debt burden of high interest is a direct result of lack of wealth within our community. Poor people and poor Black people specifically have to keep relying on expensive installment plans that extract resources out of our community that need it the most. This not only hurts our community, but ensures instability within our community, Madam Chair. It continues the cycle of poverty within our communities, Madam Chair. Colleagues, I say to you that we cannot penalize ourselves for the laws that adversely affect and burden poor people for the past several decades. But for the sake of economic injustice that is taking place at this moment, we can assure that it will not happen for the next 40 years, Madam Chair. Imagine if you are that young man. Imagine if you're paying $300 a month for liability insurance, but you were able to save $100 and put that right back into your community. Imagine if you were able to cut that in half, that 150, and be able to save that 150, what our communities would look like. Madam Chair, I submit to you that poor people and poor Black people are working too hard for the wages to have exploitive businesses connect with arbitrary barriers in statute when we should be wealth building in our communities, and our elected officials should be helping us do just that. Some of the people are going to say that this is going to hurt small businesses, that it will be a challenge for small businesses, that these arbitrary barriers that we put in place for poor people, poor Black people should be there. Well, I say as an entrepreneur, Madam Chair, for the past 20 years, businesses are built off of innovation, creativity, and superior service as we evolve. So we didn't put in barriers in statute when Blockbuster and West Coast Video saw the red box coming. We didn't put in arbitrary barriers when the payphone was introduced to the cell phone. We didn't put in arbitrary barriers or make excuses when we stopped using cassette tapes and went to CDs. Madam Chair, it is important to recognize that MAIF represents 2% of the insurance market that we're talking about at this moment, but they disproportionately affect poor people and poor Black people, which is why I speak with the passion and conviction to make sure that we bring about a resolution for this issue. To its core, Senate Bill 278 follows DLS's recommendation to give options to poor people, poor Black people, to have a lower down payment and more installments. It is to ensure that it also has a provision that ensures that Maryland Insurance Administration and the General Assembly have the safeguards in place to pay attention to this issue with their oversight. Madam Chair, I was very upset with myself last year when I did not take action and put this bill in last year. But I stand before you as humble as I know how to, with an attempt to make sure that the young Corey McRae, the next Corey McRae, can keep wealth in his community by bending our moral compass and restoring economic justice to this issue that rightfully deserves so. Colleagues, you'll vote for a favorable report for Senate Bill 278.
Thank you. Are there any questions? Okay. We're going then to Al Redmer from MAVE. How you doing?
Madam Chair, I'm doing great. It's good to see you and members of the committee. And I kind of took a pause before I said hello because I wanted the powerful comments from Senator McCray to sink in a little bit because they were powerful. And this is, quite frankly, a straightforward bill that would simply allow MAIF to offer the same type of installment plans that are routinely offered by every other insurer. The bill simply removes the installment payment restrictions, the barriers that the senator discussed. It concerns how a policy is paid for. It has nothing to do with who is insured by MAIF. Those restrictions do not change. The plans we offer now are restricted by statute and are extremely underutilized. 2% of our policyholders use installment plans with us. Everybody else uses the premium finance company. And there's no reason why our policyholders should be in the position of having to finance their premium payments and pay interest. Our average is about $255 of interest per MAIF policy. And by removing the restrictions, let me be clear, it does not make us a competitive insurer. Maryland Auto's status as a residual insurer of last resort would not change. We would still be the insurer of last resort for Maryland residents and could not insure anybody unless they've been turned down by two other carriers or canceled by a single carrier, the same rules that are now in place. So we would not see a significant change, except possibly, I believe, we might see an increase in policyholders by insuring people today that otherwise go uninsured and drive around without insurance. Our installment plan would have to be filed and approved by the Maryland Insurance Administration, taking into consideration the down payment and the number of installments. And as the senator mentioned, any changes to that after the initial approval, the commissioner would be required to file a report about the change to the General Assembly. Now, the Insurance Administration continuously reviews our financial status as they do other carriers. And we discussed this bill with the Insurance Administration, and they pointed out and assured us they would not be approving any plan that would put us in financial impairment to Maryland Auto or do anything that would precipitate any kind of an assessment. As a matter of fact, this bill would not make an assessment more likely. It should make it less likely, as the cost to insurers would be less and our retention would be a little bit better. Our 2021 surplus is around $49 million. The assessment trigger is $18 million. So there is no assessment anywhere near in our forecast. The bill would not make an assessment more likely. Again, it should make it a little bit better because of better retention. I also want to point out, we do not write any direct business. All of our policyholders have a producer. Our underwriting system allows the selection of a MAIF installment plan or going through a premium finance company or paying the premium in full. That system would not change. So any producer currently using premium finance companies would be able to continue to do so if this bill were to pass. And the last point I'm going to make, and I'd like to emphasize, there have been comments that this proposed change would potentially put us in financial risk and possibly lead to an assessment. And I want to emphasize that any plan we offer has to be approved by the Maryland Insurance Administration. And having been very familiar with that organization, I can tell you with personal experience, that the experienced, talented professionals at the Insurance Administration take the financial solvency of carriers and the protection of policyholders very, very seriously. And to state otherwise is really nothing more than a red herring and a misguided criticism of the administration that they would allow such a thing to occur. And with that, Madam Chair, I would like to introduce our Chief Operating Officer, Dave Pfeiffer, to just take a couple minutes to talk about the operational aspects of the legislation.
Okay, we had him listed next. All right.
Thank you.
Good afternoon, Madam Chair. I am Dave Pfeiffer, and I am the Chief Operating Officer, and I'm here to testify in support of Senate Bill 278. As Al said, I'm going to add some operational comments to what he has already explained to the committee. Maryland Auto has anticipated and is prepared for an increased workload related to changing the installment billing. We expect an increase in phone calls within our fiscal, underwriting, and claims operation to address any additional customer needs that would come from this. We also have adequate staff and backup within the organization to redeploy to cover any anticipated changes in the workloads that may occur from this bill. We currently have installed an automated billing system called PBS, which has the capabilities of handling any additional installment plans that we might install. It is a relatively straightforward to adjust these existing programs to accommodate any additional plan that the Maryland Insurance Administration might approve for Maryland Auto. Our current systems do provide the ability to send out installment invoices at whatever regulated degree we choose. We can accept various types of payments. MAVE can even allow policyholders to make credit card payments online 24 hours a day, 7 days a week. We also can issue cancellation notices, reinstatements as needed to comply with anything that the customer might need. So from our standpoint, we don't foresee any operational issues with the changes. And given that producers still have the greatest influence over how customers buy and pay their premium, we don't expect a dramatic change in the foreseeable future, but we are prepared for whatever might happen. And with that, thank you for allowing me to give you my side of this argument.
And our sponsor was so passionate that I forgot to tell everybody we really had 2 minutes each, and we're now going to Sandra Dodson from May.
Thank you.
Good afternoon, Chairman Kelly and Vice Chairman Feldman. I'm Sandra Dodson from Maryland Auto Insurance Fund.
We are losing you.
Additional comments, we urge a favorable report.
Okay. All right. Let's go next to Greg Taylor from the Insurance Outlet.
Good morning, Madam Chair, distinguished members of the committee. Thanks for giving me this opportunity today. I want to speak out. I'm somewhat concerned about the bill. There's an awful lot of gray area. One of my concerns is for 40 years, Maryland Auto has been representing two customers, and we've given them the ability through the premium finance industry that they have 40 days from their due date to make a payment. During that time, they can make a payment up to the 39th and 40th day with no adverse, implication. You start going to a direct bill option, they're going to fall back into play with the rest of the direct bill carriers that are out there, which is 15 days. Otherwise, they go into a cancel status, which would put more uninsured motorists on the roads. The other concern that I have with this is we don't have the implementation time to change an industry that's been doing this for 40 years. It's going to take time to do this, and nobody from the insurance industry, from the finance industry, from the agencies have been really brought in, to hear our opinions on this. We saw this bill, just come out less than a couple of weeks ago. I've spoken with several finance companies. We've kind of put numbers together. I have not spoken to all of them. They're taking 60,000 calls a month, from customers. And a lot of times people don't understand. They hear that number. They're like, well, that's more people than are in MAIF. Well, that is true, because the average person that's calling into the finance company is calling in, when's my payment due? What's the last day I can make a payment? Hey, I missed my payment. What's the last day I can reinstate? So if we only take a percentage of those, is Maryland Auto truly able to handle an extra 10 or 15,000 calls a month? And then in the bill, it says there are no financial implications, as a result of this. I'm having a hard time understanding how they could take on that kind of call volume without there being some sort of financial implication. If we turn around and use that same, 25%, variation, if the average person's paying $2,500 a year and MAIF gets the entire premium from the Premium Finance Committee or the Premium Finance industry, they only pay out a $250 commission to the agent, which leaves them $2,250 for investment income, pay claims, and other administrative costs that the insurance company has. If they go to this down payment and they take a 15% down payment, you're going to be getting $375. You're still going to owe the agent the $250 commission, leaving MAIF with $125 to invest and to pay claims. I don't understand how we can go from $2,250 to invest and pay claims to $125 with no ramp up time and have no adverse effect financially.
We're going to have to thank you for your testimony. And if there's something more you want to send us in writing, we'll look forward to receiving it. Okay, we're going next to Marta Harding, the Premium Finance of America, Inc.
Good afternoon, Madam Chair. I'm Marta Harding. I'm here today on behalf of Premium Finance of America, a small business premium finance company located in Baltimore County that's been in operation for 30 years. You have our written testimony. I know my time is limited, so I'm going to try to focus on a couple of specific points. We certainly acknowledge that the bill requires MIA approval of a payment plan, but it doesn't require on its face or anywhere in Maryland law that we are aware of, or even appear to authorize the MIA to consider the administrative costs of the plan or the impact of the plan on MAIF's financial stability or on its already high cancellation rate. Instead, and this is very important, it directs the MIA to consider the affordability of the plan in comparison to other options. That is an unprecedented legal standard in the insurance article, at least to our knowledge, and it is in fact diametrically opposed to considerations of financial stability and keeping people insured and keeping cancellations down. As the committee is aware, and as Mr. Redmer mentioned, we have an assessment mechanism in Maryland law where if MAIF's operating losses reach a certain point, all vehicle policies in the state are taxed to make up for the shortfall. As the sponsor mentioned, the law prohibited a payment plan for many years after MAIF was established, but that wasn't to create an industry or to create any special treatment of a premium finance industry. That was to protect MAIF solvency. Now, in 2013, this committee carefully looked at that issue and came up with what we think was a well-balanced alternative to the complete prohibition to allow what we think is a fair payment plan, but one that ensures that MAIF's solvency is not impacted. Our current payment plan is among, if not the most generous, one of the most generous payment plans of all residual market in the entire country. The average across all residual markets is approximately 30% down and 5 payments. And that is according to the Automobile Insurance Plan Service Office, which provides services to residual markets throughout the country. I will provide the information to staff. I had intended to attach it to my testimony and just mechanically couldn't get it attached. So I will provide that to staff, that information that this committee had before it in 2013. So that you have it again. We certainly acknowledge the concerns with affordability that were raised by the sponsor. We have great respect for the sponsor and the concerns that he raised, but the solution to those issues is not to scrap the careful balance that this committee, as the Insurance Regulatory Committee, struck in 2013 between allowing insureds to have a payment plan, but protecting MAIF's financial solvency and protecting the state's uninsured motorist issue as a result. So for those reasons,
Okay.
we would respectfully request an unfavorable report. Thank you, Madam Chair.
Let's say we'll keep this open a couple of days for anything that anyone wants to send in writing. I will say that MAPE is absolutely more necessary now than ever, considering how many essential workers in places like Baltimore City don't have any alternative for getting to work. We're losing businesses. Economic development altogether is being impacted when you don't have a functional, systematic bus system that will get everybody. And there is no school bus system for Baltimore City. So kids don't have a way, if we don't do things virtually, and many of them live in communities where there's no broadband. Literally right now, what MAPE is asking, I think might be more necessary than under ordinary circumstances, maybe some people would think to be the case. But there are many people, you don't want them out there driving with no insurance. MAPE only has 2% of the business. And so if you want to tell us something more, we don't know. We won't vote right away. We'll wait to hear back further what we are missing, if we are missing anything. Senator Augustine.
Thank you, Madam Chair. I just a curiosity. Maybe Ms. Harding can tell me what the interest rates your folks are charging people and how that is regulated. I mean, that's driving up these costs.
Yes, Mr. Chairman, excuse me, Senator Augustine. Yes, it is the insurance. I should say everything that a premium finance company charges is regulated by Maryland law. The insurance rate, to my knowledge, has not, or the insurance charge has not changed for decades. I mean, I believe it was set perhaps when the statute was originally enacted, but certainly going back to the 90s. And it is 1.15% for each 30 days charged in advance. That is, I can give you the statutory site. I'm trying to turn to it as we're talking, but it is regulated by statute, as are all the fees that are charged.
So does that annualize to 18%?
It's for each 30 days. So it
does annualize to
for a 12-month policy.
in excess of 18%. Okay, that's what I wanted to understand.
Can I provide some clarity? That is not accurate. The statutory, this is Greg Taylor.
I'm sorry, you weren't called on, sir.
You
can't do that.
Can't just butt in that way. Okay, Senator Augustine has the floor.
Thank you, Madam Chair, and I really appreciate your answer, Marta. I'll follow up with you offline.
Yeah,
thank you.
I'm just double checking the statute as we're talking, Senator, and it's 23-304 is the finance charge. And and there was actually some litigation about how it has to be calculated. And we have a specific method for how earned interest is calculated, but it is an amount not exceeding the sum of 1.15% for each 30 days of the loan, which is computed in advance. And that's right out at 23-304.
Wonderful. Thank you very much for that.
Thank you. Colleagues and all speakers and all representatives of different aspects of the industry. I don't know why the lights keep going out. We will hold the bill for 4 or 5 days, definitely, before we vote. So if there's something you need to send in writing to help us understand more. But my own concern is that if there were ever a time when we need people to have automobile insurance, and it's got to be affordable given what's happened to the economy, and a lot of people cannot work at home virtually, and some who have decided just to quit work or not to do anything are causing the supply chain problems to be escalating, and we all are paying for it. We need MAPE. We need the entire universe of insurance possibilities that now exist. And we want to be sure we're being fair to everybody and that we're looking at the total picture. So we will help put this on hold for a few days. If you have something to send in, please do so. We would appreciate. Okay, and that ends the testimony on Senate Bill 278. Thank you. All right. Is Senator Feldman back?
Yes, I'm
Yes,
back. Madam
okay.
Chair.
All right, you're up for Senate Bill 301, private passenger motor vehicle liability insurance and so on.
Thank you, Madam Chair. So Senate Bill 301 is, it's a simple bill, actually, and it's basically from where I sit, it's correcting a misfire the committee made back in 2017. We had identified a problem. We tried to fix, it didn't really quite work. And so from where I sit, again, the insurance industry doesn't like this bill. You'll see a lot of the testimony in opposition. It's largely because here in Maryland, the industry's been taking advantage to some extent by the fact that Maryland drivers actually do not have any idea about a little glitch in the way auto insurance works when you get into an accident. And we identified this issue back in 2017. I'll explain it. We passed a bill here in the Finance Committee directed at that issue, thinking it would address the issue. But again, we did misfire, thus the introduction of Senate Bill 301 to try to get it right this time. And so prior to 2017, Madam Chair, if I could just give a little history for the committee, here was how it worked in Maryland. We have two drivers. Driver A, I'm looking at our committee here. We're going to say it's Senator Hershey. Driver A has $30,000 in insurance, okay? And Senator Hershey plows into Senator Reedy, driver B, who also has $30,000 of insurance. No question it's Senator Hershey's fault. The accident causes driver B, Senator Reedy, $50,000 in damages. So again, Hershey has $30,000 insurance. He's been paying premiums on for many years. Reedy has $30,000. The damages to Senator Reedy is $50,000. And so of course, that $30,000 Senator Hershey holds goes towards those $50,000 of damages to Senator Reedy. Now you would think, and most Marylanders, I believe, think that extra 20 would be covered by Senator Reedy's $30,000 coverage, that $20,000 shortfall. You got the 30 from Hershey, but the damages to Reedy are 50, and that his 30 would cover that other 20, that shortfall. After all, both parties have been paying $30,000 each on the coverage. Unfortunately, you would be wrong. You would have been wrong prior to 2017. That was not the case. Actually, Senator Reedy's insurance carrier would pay $0 to cover that $20,000 shortfall. And the reason, the way it worked, and again, Zilcho. So what would happen is that $30,000 under Senator Hershey's policy would be credited against Senator Reedy's $30,000, which gets you to $0. So I know this doesn't make a lot of sense, but that's how it worked prior to 2017. So again, the total coverage for that accident of $50,000 would be $30,000, and Senator Reedy would be out of pocket $20,000. His $30,000 coverage did nothing for him. And so that is, again, I think most people don't get that. I don't see Senator Bidle. She was in the insurance industry for a long time. She would probably understand it, but the average Marylander would not get it. So what happened in 2017? This issue was presented to the committee in Senate Bill 403 to address the issue, to allow the stacking of the two policies. That is, rather than having that driver A Hershey $30,000 count as a credit and offset against the Reedy $30,000, the 2017 bill allowed driver A and driver B's two $30,000 policies to stack. And we passed legislation in 2017 on a bipartisan vote out of this committee, 9-1, passed the Senate floor, that would allow stacking. And that is current law, okay? Essentially requiring the driver, but here's the glitch. In the 17 bill, we required the driver to affirmatively ask to have the stacking coverage, and what we call it's enhanced underinsured motorist coverage, in order to be able to stack. They would have to affirmatively, they were allowed to do it in 17, but they had to affirmatively ask And the problem there was, and we now know 5 years later, nobody knows to ask. Everybody assumes that if the driver that hit me has 30 and I have 30, that I'm going to have $50,000 worth to cover the damages. But most people wouldn't know to ask, and in fact have not asked. And if you look at the testimony from State Farm and others, you know what percentage of Marylanders have taken advantage of this opt-in asking for stacking coverage, which by the way costs like $2 to $5 a month? Less than 1%. 99.5% of Marylanders have not taken advantage of that because candidly, they don't know to ask for that. Now, I think the insurance, well, and I'll let the insurance industry. So now we're in 2022 and we have the benefit. And again, I'll reiterate, I think most Marylanders assume that if they got hit by somebody with 30 and they have 30, they'd be covered. And nobody knows to ask for this extra coverage. So because nobody's asked and opted in to get this extra coverage, we're basically nowhere better than we were pre-2017. So what's Senate Bill 301 do, Madam Chair? It addresses the issue and it gets Maryland drivers to where a vast majority actually think they already are. It doesn't affect whether stacking can happen. We settled that in 2017. You can do it on an opt-in affirmative basis if you would even know to ask. But what it does do, Senate Bill 301, is it changes the dynamic, basically from an opt-in to an opt-out arrangement so that you get the coverage unless you affirmatively don't want it and waive it. So this is an opportunity for Marylanders to get what they already have on an opt-out basis, as opposed to having to affirmatively ask a question they don't even know to ask. And clearly the data in the last 5 years bears that out. So under the bill, just like current law we have for PIP coverage, drivers will be told what the cost of the stacking policy is up front, and the driver can decide whether he wants to pay that extra $2 or $5 a month to get that stacking coverage. Again, the driver can decide whether they want to pay that extra amount. And so without the bill, while stacking is permissible in Maryland, nobody knows it exists. They're still going to be holding on to that $20,000 shortfall that I was describing that Senator Reedy would be holding. So this again shifts from an opt-in, which is what we created in 17 and allowed stacking, to an opt-out where you get it unless you say you don't want it. And so with all that, Madam Chair, that's in a nutshell what Senate Bill 301 does. We tried this in 17, we misfired. I think this corrects it and puts the coverage where I think most Marylanders already think it exists. So Madam Chair, I urge a favorable on Senate Bill 301. Thank you.
Thank you very much. Are there any questions? All right, now for our, we've got a lot of interested and expert witnesses on all sides, and everybody will have 2 minutes each. All right, we'll start with Rob Gargiola, Compass Advocacy.
Thank you, Madam Chair and members of the committee. Rob Garagiola with Compass Advocacy on behalf of MAJ. I want to thank the Vice Chair for sponsoring this legislation. I also want to thank Senator Klossmeyer and Senator Benson for co-sponsoring this bill again. They actually co-sponsored a very similar bill back in 2017. I think Senator Feldman did an exceptional job. I actually brought my props, I guess it was Hershey and Reedy, as far as, who hit who and what the outcome would be. The bottom line is the senator mentioned, most Marylanders, I would say nearly every Marylander, and I bet if I polled the committee, most of you and your staff probably did not ask to opt into this coverage, and we're unaware of this coverage. And what you're going to hear from others that are going to be following me is that when a driver thinks about this, is after they get into the car accident and they sustain substantial damages. And that's when they think the premiums that they were paying all along to their insurance carrier mean that they're going to get proceeds from their insurance carrier and not have it credited from the person who caused the accident to make them whole and not be out of pocket, for lost wages or medical bills or damages to their car. That's what we're talking about here. And so the policy of stacking, basically putting the driver's policy who caused the accident, as well as the driver who was injured in the accident, being able to put them together. That policy was settled in 2017 overwhelmingly. I think all but one senator from this committee then voted in favor of that legislation. What we're talking about doing is allowing an opt-out scenario where essentially, much like we do today for PIP coverage. So for PIP coverage, each driver basically is going to get PIP coverage unless they are presented with, here's what it costs, initial here if you want to opt out. That's the law in Maryland today. And we're looking at doing it with this. So you'll get a piece of paper that basically says, if you don't opt out, you're going to get this coverage. And by the way, this coverage is going to cost $2 or $3 or $4 or $5. I mean, that's what we're talking about each month. And the driver can make the decision like they do with PIP, whether they want to opt out and not pay that additional premium. You're going to hear from some in the opposition that this is going to raise all kinds of costs and you're going to have, out of runaway lawsuits, for injuries. That's not the case. It's not borne out. It's up to each driver to decide if they want to pay for this, but they're going to be educated by the carrier now where they aren't today. So with that, I would urge a favorable report. Thank you, Madam Chair and members of the committee. Happy to answer questions once the panel is complete.
Thank you. Are there any questions? All right, we'll go next to Bruce Flaxen, Maryland Association for Justice.
Gwen Marie.
Thank you, Madam Chair. Thank you, members of the committee. It's an honor to be in front of you. I testified on this bill in 2017 when it was basically in this form, and I believe it was amended over in the House, or it was as a compromise, but it was always meant to be an opt-out, because the only way to have full disclosure and transparency is if the insurance carriers actually tell people about this coverage. And Senator Feldman and Rob, you talk about the carriers not, that people have to elect to obtain this coverage. And that's the language used in 19509. But the language in 19509.1, when we passed this bill, it was always thought that the agents or the companies would have a discussion with their insureds, because it says in 19509.1C, 1, an insurer, and I'm reading exactly, shall offer enhanced underinsured motorist coverage. And then if you go down to E, it signifies that it must be on a form required by the commission. Nobody I know has ever been offered that. The carriers right now are violating the current law, and there are no provisions in the law to police them. The only way we can provide this coverage to people is if you make them read it and you see what the cost is. That's how you disclose, and that's how you bring transparency to your constituents. I don't know what it means to say, and I do know what it means. An insurer shall offer enhanced underinsured, but nobody is offering it. I can tell you in my office, my partner David's on here, we handle over 500 auto cases per year. In the 5 years that this bill has been passed, not a single person that we have represented has come to our office with enhanced underinsured motorist coverage. As Rob Garagiola said, you settled this policy in 2017. This General Assembly has already decided that the public policy is to be transparent and to disclose and make this offer. It's good for your constituents. It's good for the hospitals. It's good for the doctors, and it's good for Medicaid. This will get bills paid. The current law leaves bills unpaid. That suffers not only the people, the victims of negligence, but the doctors that treat them, their employers, their unions, and health insurance carriers that cannot subrogate. There are all types of things that happen when people don't get paid their full value. And the only way to do that is to require an opt-out.
You're a bit over.
Thank you, Madam Chair. I'm sorry I went over. Thank you, everyone. Urgent, very favorable.
Any questions of this witness? Okay, we're going to Gwen Marie Davis.
Hello, Madam Chair. My name is Gwen Marie Davis, and I am the managing partner at GDH Law located in Lanham, Maryland. I'm also here on behalf of the Maryland Association of Justice, and I ask that you would be in favor of SB 301. You've heard what it is and the need for it, and I just want to reiterate what my colleague has said. I have seen numerous numerous clients in my office come in with catastrophic injuries, significant injuries, who were injured in a car crash with someone who has had a policy of $30,000, some injuries may have been a torn rotator cuff, needed surgery, or have had significant injuries. I checked to see, knowing that there is a bill, that bill had passed in 2017, to see whether or not their underinsured motorist coverage would be able to combine both of the policies to help pay for some of their bills, out-of-pocket expenses, and things like that. Not one time since the bill has been passed and into law have I seen a client been able to benefit from this. What I realize is that the clients do not know about it. Here today, I have one of my former clients, Miss Anjanila Gregory, who you will hear from as well too, who was injured. She's a former NCAA referee in a car crash, and some of the injuries that she has sustained. But she's just one of many of my clients who would benefit from this opt-out. And it's just like we currently have with the PIP, the personal injury protection, where you have to waive in Maryland, the PIP. That would be the same thing here. You would just have to waive and at least know you had the knowledge of it, you were educated of it, and you made an educated decision to waive having this policy. Thank you for your time, and I appreciate, and I hope that you would vote in favor of this bill. Thank you.
Thank you. Are there any questions of this witness? All right, we'll go next to Anjanila Gregory.
Good afternoon, Madam Chairperson. For some reason, there's a different name under my face, but that's okay. Members of the committee, it's very important that this law is passed for several reasons. In February 2019, I was on my way home from a basketball game. Me and my partner, we stopped to get gas. Another motorist was on the other side at the same red light as us. He ran the light, hit us head on. We have very significant injuries. With all that's going on with me 2 years later, I'm still going through therapies. I still have very, very bad pains. I have a brain injury, PTSD. The insurance did not cover all of my bills, and still I'm using my personal insurance for all of the injuries that I'm going through. Mind you, I am not able to work. I lost my career at this point. With the brain injury, there's times I can't get out of the bed. I can't stand up, or I'm in so much pain in my head, I end up on the floor and no one's there to help me. I've called Gwen Marie several times in tears. That bill is important because maybe if it had been stacked, I would have been able to get all of the medical attention that I needed at the time. And I wouldn't be in the situation that I am in right now. That bill is very important to all of us that are home injured, some that may have even passed on from their injuries. That bill should be the most important thing to all of you, because imagine yourself in this same situation.
I hate to butt in, but your time is up. But thanks so much. It's good to hear from a person who's living what you're talking about.
Thank you.
Okay, we're going next to James McAllister.
I think the name's got changed.
All right, is he no longer here? All right, then to David Munsey.
Thank you, Madam Chair, and members of the committee for having us this afternoon.
I'm David Muncie. I'm with the Maryland Association for Justice and also practice with Bruce at Plax and Adler Muncie in Columbia, Maryland. I'm not going to repeat everything that my colleagues said. I just want to make sure everyone understands that this situation only arises when someone like Miss Gregory has a very significant injury or a death. Most claims are taken care of within the liability policy limits. It's only the most significant of injuries or death cases that require going into the client's underinsured motorist coverage. And this bill will make sure that consumers are allowed to make an informed decision about how much coverage they want, and they're not surprised by a hidden deductible when it's too late and they've had a significant injury or a death, and they find out that they don't get the full benefit of the coverage that they thought they've been paying for all these years because their carrier gets a credit for the amount paid by the liability coverage. So what this bill does is essentially, as was explained many times, allows consumers to make an informed decision, see the cost difference between getting this coverage or not getting this coverage, which is not happening right now. I was not surprised to hear Senator Feldman say that less than 1% of insurance consumers have this coverage because, as others have stated, we haven't seen one person have it in the 5 years since the policy was passed. So I'd ask you to urge a favorable report on this bill and put into action what was supposed to happen in 2017, but has unfortunately not come to fruition. Thank you.
Thank you. Are there any questions of this witness? Okay, we're going now to Bryson Popham, unfavorable.
Thank you, Madam Chair. Good afternoon, members of the committee. First of all, I'd like to say that with great regret, I'm opposing a bill that the Vice Chairman has introduced, but sometimes we do part company, and this is just such an example. I'm appearing in opposition to the bill on behalf of two clients, the Maryland Association of Mutual Insurance Companies, and also the insurance agents and brokers. I was there in 2017, and I'd just like to tone down the rhetoric a bit and point the committee to something that you have in your files right now, I think that is dispositive of this debate. It is a letter submitted to you by the Maryland Insurance Administration dated January 27th, 2022. And I just want to point out two things, two very brief things in that letter, commend them to your attention, and I think this will tell you what you need to know about this bill. The first thing is on page 2. It is the first sentence in the 4th paragraph, which reads, the refusal of consumers to elect EUIM coverage likely reflects the fact that it is only in the rare instance of a large damages claim caused by an uninsured motorist that the purchase of EUIM provides a benefit to the consumer. Right there is the reason that you don't have a greater take-up of this coverage. And even better, the MIA has underscored that criticism on the next page at the top in bold when it says consumers are best protected by current law. People will buy what they believe they need to buy. And as I said, I was there in 2017 along with the rest of the industry and many of the people on this call. We had a vigorous debate. It was resolved with the current law as it stands today. The trial lawyers accepted that resolution, I believe, with enthusiasm. That's my recollection anyway. And I think the law works today for the benefit of those who need it. But to require people to purchase this coverage and then go through multiple steps to eliminate it from their policy is simply going to add to the cost. Madam Chair, you referred earlier to affordability. This is an expensive product. I agree. This doesn't do anything for affordability except make the product less affordable. And for these reasons, we would respectfully request an unfavorable report on Senate Bill 301.
Bryson, let me just ask if, and then I'm gonna call on the sponsor. Would you agree almost nobody is using this right now?
To my knowledge, that is correct. Very few people are, Senator.
So when you offer something, whether it's for dinner or for insurance coverage that might be needed and almost nobody is using it, wouldn't it suggest that something about that product, the way we are promoting it or not in Maryland is problematic, wouldn't you think?
Madam Chair, I would respectfully suggest you need to examine the need for that particular highly specialized coverage and go back, please, to the MIA comment about it They pointed to the very rare instance when that coverage would be usable. People make decisions on a rational basis for themselves. They make the decisions rationally that they do not need that coverage. That's why so little of it is sold.
Okay, I just was wondering if they don't ask for it because they don't understand it or it isn't clear.
I do agree. It's not the easiest thing to understand. I do agree with you there.
Okay, the sponsor has his hand up and then we'll go.
I'm looking at the same MIA language, and I guess I just don't agree with the fact they're saying the fact that nobody has it is because there just isn't demand for the product. I mean, to me, that's not necessarily at all the case. I just simply don't, and I asked the committee to think to themselves. I gave you, the hypothetical of a Reedy situation. I simply do not think people know to even ask, and particularly if they're not being, sort of. I hadn't recalled the 2017 bill that put an affirmative obligation on the case in the case of an agent to sort of educate the consumer. I think most Marylanders absolutely do not know that this is the case, wouldn't know to ask. I think that makes more sense than the fact there's not demand for the product. It's more commentary, Chair Kelly, but I'll just leave it at that. I'll yield back to you.
Thank you.
Madam Chair, may I respond?
Wait a minute, I've called on Senator Reedy.
Okay.
Senator Reedy.
Sorry. Thank you, Madam Chair. I guess, Bryson, my question, I'm looking at this bill closely, and I wasn't here in 2017 and on the committee. I think they make some great points. The proponents make some great points about how this trips people up. I have some heartburn about the idea of having it automatically, though, go on people's bill. And I think so. I'm piecing through that as I look at the testimony. Would you acknowledge that if there was maybe the middle ground was something where it's more clear on the front end that people can be offered this and they know what it is they're turning down? Because it does seem odd to me. I've bought, obviously I have car insurance. I don't know that I've ever consciously made this choice. And with young kids, I might want to make sure that I had some extra coverage. I'm not sure that I do at this point, not extra coverage, but just, I might want to make sure that I have that stacking. So, I mean, can you comment on that? Is there maybe a middle ground here?
Yeah, thank you, Senator. I can address both your question and the vice chair's comment at the same time. And I was about to say to him, if you want to do something, perhaps better education, better consumer education on this admittedly difficult to understand coverage would be a better approach, but just don't make everybody buy it and then have to go through the difficult process of eliminating it if they decide they don't need it, because most people will decide they don't need it. So I would respectfully suggest that if the committee feels compelled to do something, then engage your regulator in a discussion about the coverage, about making sure consumers are properly educated about the coverage. Frankly, I think that would be a better approach than simply making everybody buy it, which is what this bill does.
If I could follow up, just one quick follow-up, Madam Chair. I guess I agree with you, but better education is great, but I'd push back some from my middle position, I guess, that I'm trying to stake out here is, wouldn't we want to, a requirement that it be more plain language for people so that they understand this as they buy insurance? I know people go through insurance brokers. I know that, people buy insurance a whole lot of different ways, but I'll leave it with that. You've sort of already answered it, but I guess I'd like to know if there's a better way that the industry can be a little more clear with people purchasing insurance, what this means if they turn this down.
It seems you are
that's kind of a rhetorical question.
Well, I don't mind hearing his answer, but if you'd like,
okay,
so you're in charge.
It seems that you and your colleagues are concerned about consumer understanding of this coverage. That is a legitimate issue each of you has raised. And I, for one, would certainly recommend to my clients and would join personally in an effort for greater consumer understanding of this coverage. But making everybody buy it is not the right answer, respectfully.
Okay.
Madam Chair, can I get one follow-up before we move to the next one?
All right.
I'll be very brief, but it was mentioned earlier that that's how we deal with PIP. You get it. Why is that so much less you talked about how cumbersome this would be to waive out. We do that currently for PIP coverage. You get it unless you affirmatively opt out. And so I don't know why this would be any more burdensome than that. And that's
But my response to that, Senator Feldman, would be that PIP has been a coverage that's been around since the beginning of compulsory insurance. It has often been requested to be made optional. And what we have, the form you're referring to, is so-called optional PIP. You can't get rid of all of it, but it is a very small coverage. The benefit is small, the cost is small. The cost for this coverage, I can't speak with precision about what this is, but it's a lot more than PIP. So you're talking about comparing an apple and an orange here, I believe.
Okay, thank you, Madam Chair. Although it says here $2 to $5 a month, and the PIP opt-out is just a box checking operation. You just check a box to opt out. Madam Chair, I'll yield back to you.
Okay, thank you. All right, we're going next to Marta Harding. You have 2 minutes.
Good afternoon, Madam Chair, members of the committee. On behalf of State Farm and in respectful opposition to this bill, it's always interesting. We agree on the fundamental fact here. Nobody's buying this coverage. Almost nobody's buying it right now. But the question is, what do we do with that? And do we force it on everybody? Or if there are concerns about people not understanding it, do we look at the tool that's being used to help them understand it and make it more understandable? If you take a coverage that by all admission is not easily understood and make people opt out of it, you're going to end up with a lot of unhappy constituents with a coverage they don't want. And in terms of the cost, I would direct you to the MIA's letter on page 2, which says that the increased cost of EUIM versus standard UIM coverage ranges from 25% to over 123%, resulting in premium increases that could range from $50 to several hundreds of dollars per policy period. That's a meaningful increase by any definition. I checked with the MIA. They have not received a single complaint that EUIM was not offered to an insured.
What it is.
That's your regulator. And in fact, the law you currently have on the book says that the MIA developed the form. And that's the form insurers have to use for the opt-out, or the opt-in currently and the opt-out that you're talking about now. So if there's a concern, and we think the form for a complicated coverage is about as straightforward as you can get, but I will provide a copy of the form that the MIA developed to staff. And if I'm sure that the regulator would be more than happy to take any commentary the committee might have about its clarity. But again, if we need to look at that, we can. We think it's clear, but it is not a solution to this problem to foist an expensive coverage on everybody when virtually nobody opts for it now and virtually nobody uses it as the MIA described in their letter. So for those reasons, we would respectfully request an unfavorable report. You also have our written testimony. Thank you.
Thanks. And you know how to be very clear, Marta. Let me ask you, is it that the people don't want it, or they don't know what it is, or the value, and then could opt out?
I think people are making, Madam Chair, an informed decision based on an explanation of what the coverage is. And the reality is that because it is such a rare instance where the claim goes above the liability coverage, even the minimal coverages under current law, the overwhelming majority, like 90, I don't have the exact statistics, so I can try to get that, but it's well in excess of 90% of claims are settled within the minimum policy limits of Maryland law. So it just doesn't come into play on the overwhelming majority of claims.
All right, we have 2 members with their hands up, Senator Benson, then Senator Bottle.
Thank you, Madam Chair. I want to ask this question of Marta or
yes.
Mr. Poppin. Did you all hear the testimony of Ann Jamila Gregory?
Yes, ma'am.
My question to you is, because of the fact that this bill is not law How do we make her whole?
You can't.
So there's no way to make her whole for a past incident, Senator. I will say that this coverage was available to her under Maryland law and was required to be made available to her under Maryland law at the time of her purchase of the policy. So
But the fact of the matter is that she was not knowledgeable of the fact that this was in place. That's the piece that is very troubling. And here we have a young woman who has lost everything. And I'm questioning why. I mean, that probably this is going to have to happen to someone else. And there's no law in place whereby the insurance companies are obligated to make people like her whole. That's what I'm worried about. How do you make, I mean,
Senator, I'm sorry.
How do you make her whole? She has indicated that she's not been made whole. She has lost everything. And it's because legislation like this has not been in place. Like, how do you make her whole?
That's a good rhetorical question, Senator Benson. I want to say to the young lady who testified, and you got your hand up, you can't go back to the witnesses, but you did a great job while you had the floor. Senator Bidle?
There we go. Thank you, Madam Chair. You know, I have a little bit of experience in this realm. And so when we would give people the option to accept PIP or refuse PIP, they always knew the cost of the coverage. We'd explain what the coverage was about, and they always knew what the cost was with the coverage and without the coverage. And you never excluded it for children under the age of 18. It was only for the named insured and spouse. So it's a kind of a different issue. But if in this case, you were going to put this coverage on and then have people sign off, I think you need to offer them the difference in price, because people buy auto insurance on price. They do. And if you load up a policy, I will tell you as an agent, if you load up a policy with lots of good things, the next thing they go down the street to another company and they get, without all these coverages, good coverages, but they got a lower price. So I think we need to be really careful with the consumer that we're not burdening them with too much premium. So I'll talk more about it in committee when we bring up the vote, but I think we need to be very careful about what we're doing to the cost of auto insurance. Thank you, Madam Chair.
Thank you. All right, we're going next to Nancy Egan. Nancy,
good afternoon, respected members of the Senate Finance Committee. My name is Nancy Egan on behalf of the American Property Casualty Insurance Association. Our members write approximately 50.9% of all private passenger auto vehicles sold in Maryland. I am here in opposition to Senate Bill 301, which increased the cost of insurance for all consumers across the state without a showing of demonstrative need by the consumer. My colleagues has provided testimony ahead of me, but I'd like to point out that based on what the MIA surveyed, 98% of the people that don't have enhanced uninsured motorists would be switched from regular offset uninsured motorists up to enhanced uninsured motorists. This will go into effect October 1, 2022. And for what I understand, this committee is always talking about affordability. Affordability is an important issue for the people that can least afford it. So here we're talking about increasing the cost of automobile insurance for about 98% of all policyholders here in Maryland. And as Ms. Harding has said, that cost can go from somewhere between $50 to several $100s per policy period. The MIA developed the form where everyone in the public had a right to input on the form that they developed. It's a 2-page form. It's under Bulletin 17-07. And the form itself describes the fact that you can get offset uninsured motorists, you can get enhanced uninsured motorists, you can waive your uninsured motorist, underinsured motorist coverage. And you are required on that disclosure form, which is 2 pages, to describe the costs in detail to the consumer about what they are being offered. This form was developed with public input. So if that public input was not in such a way that people are understanding it and there is concern by the trial lawyers that have testified, then they need to go back to the Insurance Administration, because this is required on every policy and every new piece of business. So this is important. It's there. So I can't explain why everyone is saying that the consumer is not understanding it on a form that has been developed with public input. I ask you to look at the MIA testimony and our testimony about the additional costs, which we calculated as 2/3 higher for a UNM cost per vehicle. So I want you to consider again about the affordability of auto insurance in Maryland, and we hope that you'll give this a no, an unfavorable report. Thank you.
All right. And we're going finally to Robert Enton.
Thank you very much, Madam Chairman, members of the committee. Robert Enton on behalf of the American Property Casualty Insurance Association. And I guess, you know, like Mr. Popham said, most of us were at the table back in 2017. You know, we'd only have 2 things that, I mean, basically what you're doing is you're mandating a coverage. But you know, you can call it opt out all you want, but you're basically mandating a coverage because people are not going to know and understand that they can opt out. The only thing they're going to see is that the annual cost of their policies went up anywhere from maybe $60 to $200 a year. That's what they're going to see, and that's what they're going to know. You know, there's no free lunch out there, as we all know. We struggle year after year to talk about affordability, about people that can't afford insurance. So we have, and you know, I've obviously sympathized with the young lady who testified, but no consumer group has come to you and said, "Oh, this is a problem. We need to increase this." None. This is about the Trial Lawyers Association wanting to add very significant limits to people's insurance policies, whether they want it or not. You know, not too many years ago, we doubled almost the maximum, the minimum amount of coverage you have. We raised it from, what was it, 1530 to 3060. And that was to make sure you had more coverage. That's a mandate. But guess what? This is going to be a mandate too. Don't kid yourself. If only 1% of the people are opting in, my guess is no one will opt out for this. If you think there's a problem with the form, if you think there's a problem that the agents aren't explaining it properly, let's deal with that. If it's explained to them and I want it, I'll get it. Most people are much more focused on getting an excess limits policy because they're worried about what they're going to be sued for. So, you know, you're going to, you know, instead of having 30/60, you know, maybe you're going to have 50/100, or maybe you're going to have $1 million excess liability. That's what people are looking out for. But this is nothing like PIP, and I don't believe we should mandate it. Thank you.
Okay. Thanks so very much. I don't see any raised hands, so that ends the testimony on Senate Bill 301.
That ends our bill.
Okay, colleagues, that's the end of our bill hearing for today. Thanks so